I want to switch gears right now and talk about how one big registered investment advisor is using ETFs to invest in 2024. John Davi is the founder of Astoria Portfolio Advisors, an investment advisor business that uses ETFs almost exclusively. An old friend of mine, I've known him for many years. John, we were talking earlier, you say you are the most constructive you've been in 2 years on the stock market. Why?
Yeah. Well, if you think about the last 2 years, you've had to deal with Fed, hiking rates, rampant inflation, corporates that were preparing for this recession that didn't wind up happening. You had negative real interest rates. Fast forward now, the picture's dramatically changed, right? You've had now inflation come off quite a bit. You've had the Fed that is talking about cutting interest rates. Maybe it's not 6, maybe it's 3. If the economy is still strong, maybe you only get 2 or 1. And you have now profits recovery. So we just think now you want to be overweight equities. You want to tilt away from market cap weight indices. So we have a much more bullish picture on the market going into 2024.
Yeah, well, we got the reasons right here. All of this makes sense. The soft landing is certainly working right now. But you've been very big on quality for a long term. This is a word, quality, which has really come into vogue in the last 5 or 6 years. It's having a moment right now. Define what quality means to you. What are the characteristics of quality, and why have we determined that these are factors that drive out performance?
Okay, so quality would be companies that, let's say, have stable earnings, not a lot of volatility in their earnings. They pay dividends. The sustainability of their dividends is strong. They increase their earnings. I would say it's blue chip companies, right? Companies that Warren Buffett would buy. So that's how we define quality, and we have like a very quantitative process for how we define it. As far as why I think it's working well, if you just look over the last 20, 30 years, MSCI has these factor indices. It is the most consistent factor compared to small caps, low volatility, growth, momentum, value. So it's the most consistent, the best risk-adjusted return. So, when we build portfolios for financial advisors, we don't want to be tactical, because I think you have to be tactical when you decide between value, small cap, growth, momentum. So quality is just much more consistent.
It's funny you mentioned Warren Buffett, because essentially what Warren Buffett turned into was a quality investor. Everyone knows Warren Buffett famously was under the influence of his mentors in the 1930s, Ben Graham, and he was a value guy, what they call cigar butt guys, picking poor companies that had underperformed off of the floor, essentially. And under the influence of Charlie Munger, he became essentially a quality investor, which you were talking about, low debt to equity, high return on equity, earnings growth, for example. And so people, essentially what's happened is the market, it's not that Buffett isn't a great stock picker, but he's employing a factor that people have determined is very important in outperformance. One of the only ones, as you mentioned, quality here. I want to move on here and talk about some other things. Let me just talk about where we are right now in the markets and what's been going on right now here. There are several ETFs that fit this description we're talking about, quality here. The biggest is the iShares Quality ETF. That's QUAL. That's been really neck and neck with the S&P 500 in the past year. And again, if you look at what's in quality, what is it? In these screens that show up in QAL, it's essentially big tech names. You see how close they are, too. But there's the S&P 500 versus QUAL. That's the blue line, QUAL, the ETF. So it's close. But essentially, if you put up what the biggest holdings are, thank you, here are NVIDIA, Visa, Meta, Microsoft, MasterCard. We talk about these names all the time. They've been hitting new highs regularly. I keep putting up Visa, MasterCard outside of the Magnificent Seven. Visa, MasterCard, Amex, and JP Morgan, which show up on these things, are the big ones. So quality seems to matter at this point of these characteristics right now.
I would point out that NVIDIA wasn't always a top holder. They were balanced last year into it. Home Depot was a top stock, so there is a rebalance in there. The stocks do change, so it's a little different from like a SPY ETF, but it is optimized against the MSCI USA index. So it is meant for like an advisor that wants S&P-like returns with, like, let's say, some overlay to the quality factor with the alpha signal that MSCI in conjunction with BlackRock is going to create.
You've got your own ETF. Everybody does these days. The Astoria U.S. Quality Kings ETF. ROE, get it? Return on equity. ROE, put that up there. But that's underperformed the S&P 500. But importantly, this is an equal weight, not a market cap weighted ETF. And I just want to show what's in it, how different this is. The other one, NVIDIA's here, but you've got Lilly, which has been a great performer, by the way, in healthcare. Lam Research, Cigna, which has been a great performer in financials as well. But you see, it's equal weighted here, so you don't get this kind of heavy weighting towards a small group of stocks. Now, why is it equal weighted?
Why is it equal weighted? Okay, so good question. So it's equally weighted because we just think when you build a portfolio, you shouldn't. Right now, if you buy SPY, it's a very defensive strategy. 7 stocks make up 30%. Okay. And I just think that you are somewhat defensive and bearish if you were just leaning in on market cap weighting at the current moment. So last year, we started to become uncomfortable with the exposures that some of these market cap weighted indices and smart beta products like Qual was giving us. So we said, look, we want to have a component of it towards equally weighted. So we prefer like a third market cap weighted, a third equally weighted, and a third, let's say, some other quant metric smart beta weighted. As far as why we made our product equally weighted, if you just look over time, equally weighted indices outperform market cap weighted. But yes, over time, so the S&P, long time, there's periods where market cap will do better, equally weighted do better. But as a long-term investor that's trying to be diversified right now, because I think you have a lot of concentration risk issues in SPY, we just wanted to make it equally weighted.
So why do you think, I'm always curious about this, in the past, it used to be the biggest determinant of, outperformance was, beta. How sensitive it is a stock to movement against the S&P 500. But why is quality won out? I mean, remember there were plenty of theories going back decades that value would outperform growth over the long term, or small caps would outperform big caps over the long term. Most people still believe that. But those two factors haven't worked as well. I mean, big caps have outperformed small caps, and growth has outperformed value for essentially more than a decade, with maybe 2022 is the exception. Why? Is there something? I'm trying to figure out what's changed here, if there is anything that's changed, or maybe we're just due for a mean reversion.
Yeah, I think that, so for me, growth and value is tied to the economic recovery, the profits recovery. When you get a profit cycle increase or decrease, that's when growth and value would work. For small caps, I think right now, it is about interest rates. And I think, when you go from 0 to 5.5%, that puts so much pressure on small caps.
But that happened recently. Small caps have been underperforming before that.
Sure, that is true. I would say that, the proliferation of ETFs, people can just, it's just easier to buy SPY. It works well over, long periods of time. Some of it is active to passive debate.
The value guys have had a tough time. We had Howard Marks here, a man I greatly admire. I have been reading his stuff for years and years, and yet they've been having a tough time of it recently. Value's really had a tough time. And the small cap value, in theory, you combine the two, should outperform long-term everything, and it hasn't for a while.
Yeah, there's an argument that you need, decades and decades. That's long term.
It's a long time we live in a world where 30 years is a long time to wait.
Yeah, but I would say that if I'm, kind of investing for 20, 30 years, again, that's part of the reason why we wanted to equal weight ROE, because we do think over periods of time, you are making a bet on mid cap when you equally weight. I would say value and growth, it is such a big concentration of sector differences at the moment. Yeah. Tech and growth.
But the big keep getting bigger. I mean, you want to talk about equal weight versus market cap weight. So in the last decade, I looked at the RSP, the equal weight ETF, against the S&P 500 market cap, and it's still, the RSP still underperforms. There's the numbers there. You can see the chart. And it's not far apart. And past the pandemic, as you got into 2021, you saw, that's the orange line, is the S&P 500, and that's tech. As tech kind of pulled away and became more dominant, equal weight had a tougher time. It's not a terrible underperformance for equal weight, but it's still there. And something has happened since then where tech has become predominant. And I mean tech, I mean communication services and technology.
Yeah, I mean, these companies are no doubt NVIDIA, Microsoft, Apple.
So is that it? It's that simple. It's a paradigm shift. It's sort of the AI play to a certain extent. But this was happening before AI even.
Yeah.
You know, they were
I
pulling
wouldn't
away.
be underweight tech or growth anymore. And those equal weighted indices, you only get 15% tech exposure. S&P is closer to 30. So again, that's why we wanted to optimize against the S&P sector weight. What I would say is that diversification, right? If I was an active manager, Howard Marks, and somebody at Howard Marks' firm had the S&P concentration risk in his portfolio, I'm pretty sure that the risk management department would come knocking on the door. So again, we just think you should own a couple different verticals: market cap, equal weight, and some quant weight.
It's certainly a good risk diversifier. I don't have any problems with that. I have no problem with the idea and the theory behind it. I just have a problem with that it's been underperforming for a while, and I keep waiting for this mean reversion because I'm an old, Eugene Fama, acolyte too. I feel the same way. In the long run, there should be some mean reversion here. But something's happening. There's some kind of paradigm shift. Maybe partly this is the AI story, just like internet was the paradigm shift in the 90s, and it kind of changed valuations dramatically. That may be as simple as that.
And they're not that expensive too, right? Like the S&P, it's only 20 times earnings. NVIDIA, I mean, some of these companies are just not that expensive compared to the internet era.